Welcome to this video on financial education for school students. We will cover fundamental concepts to help build a strong financial foundation. We begin with Chapter 1, Introduction to Money. We'll explore what money is, its history, different forms, and its essential role in the economy. Money is a medium of exchange that facilitates buying and selling. Its key functions are acting as a medium of exchange, a unit of account, a store of value, and a standard of deferred payment. The evolution of money started with the barter system, moving to commodity money, then metallic and paper money. Today, most currency is fiat money, valued based on trust in the government. Modern money comes in several forms, including physical cash, credit, which is borrowed funds, and digital money, such as electronic transfers and cryptocurrencies. Money plays a critical role in the economy by facilitating trade, providing a price mechanism, promoting investment, enabling monetary policy, and supporting global exchange. Chapter 2 focuses on personal finance basics, providing an overview of managing your own money. Personal finance involves managing an individual's money, including earning, saving, spending, and investing. The goal is to achieve financial stability and well-being through proper resource allocation. Income is money earned from various sources. Expenses are either fixed or variable. Budgeting is the plan to manage income and expenses effectively for savings and spending. Financial goals can be short-term, medium-term, or long-term. Remember to use the SMART framework for goal setting: specific, measurable, achievable, relevant, and time-bound. Saving is important for building an emergency fund, ensuring financial security in retirement, enabling investment opportunities, and achieving major life goals. Chapter 3 covers understanding banking, providing an overview of how banks function and the accounts they offer. A bank is a financial institution that accepts deposits and provides loans. Banks facilitate payments, support wealth management, and contribute to economic growth. We have different types of banks, including commercial banks, investment banks, retail banks, nonprofit credit unions, and central banks that regulate the system. There are two main types of accounts: savings accounts for earning interest on long-term goals, and checking accounts for daily transactions. To open an account, select a bank, choose the account type, and provide personal information. Online and mobile banking offer convenience and efficiency for account monitoring, transfers, and bill payments. However, security concerns and limited physical access are challenges. A budget is a financial plan that allocates income toward expenses, savings, and investments. Its benefits include financial control, debt management, and emergency preparedness. To create a simple budget, list your income, track your expenses, set priorities for needs versus wants, allocate funds using methods like the 50/30/20th rule, include savings and debt repayment, and review and adjust regularly. You can track income and expenses using spreadsheets, apps like Mint or YNAB, or physical methods. Regular checks of receipts and bank statements ensure accuracy. To adjust your budget and meet goals, reassess your spending, cut non-essential expenses, automate savings, and focus on debt repayment using methods like debt snowball or debt avalanche. Chapter 5 covers saving money, including why it's important, different types of savings accounts, setting up a savings plan, and the power of compound interest. Saving is crucial because it provides a financial cushion for emergencies, helps achieve long-term goals, promotes financial independence, avoids debt, and reduces financial stress. Different savings accounts include traditional accounts with easy access, high-yield accounts with higher interest, money market accounts, certificates of deposit, and specialty accounts like HSAs and ESAs. To set up a savings plan, first identify your goals. Calculate how much you can save, automate transfers, track your progress, and adjust the plan periodically based on life changes. Compound interest is interest calculated on the principal plus previously earned interest. The earlier you start saving, the more compound interest works for you due to the power of time and compounding frequency. Chapter 6 explores understanding credit, covering what it is, types of credit, how it works, and the importance of a good credit score. Credit is an agreement where a borrower receives value today and promises to repay it later. Key terms include the borrower, the lender, the principal amount, and interest. Types of credit include credit cards, which offer revolving credit, and various loans, such as personal loans, auto loans, student loans, and mortgages, which provide a lump sum with a repayment schedule. Credit works by allowing borrowing now with the promise of repayment with interest over time. The process involves application, approval, and adherence to the agreed terms and interest rates. A good credit score is important because it opens access to credit, lower interest rates, and favorable terms. Build and maintain credit by making timely payments and keeping utilization low. Chapter 7 provides an overview of debit versus credit, comparing the functions and implications of debit and credit cards. A debit card makes purchases directly from your bank account. Key features include immediate deduction of funds, no interest charged, and use for ATM withdrawals, though there is a possibility of overdrafts. A credit card allows you to borrow funds up to a predetermined limit. Key features include interest charges on unpaid balances, the option for minimum payments, and a significant impact on your credit score. Pros of debit cards include no debt or interest charges and convenience. Cons are limited fraud protection, no impact on your credit score, and potential overdraft fees. Credit card pros include building credit, fraud protection, and rewards programs. Cons involve potential debt accumulation, interest on outstanding balances, and the temptation to overspend. For responsible credit card use, pay your balance in full, monitor spending, avoid only making minimum payments, keep credit utilization below 30%, and check statements regularly for errors. Chapter 8 introduces loans, focusing on understanding types, interest rates, and responsible borrowing practices. A loan is a financial arrangement where money is borrowed and repaid with interest over time. Loans can be secured by collateral or unsecured. Common loan types include personal loans for various expenses, auto loans for vehicle purchases, and student loans to cover education costs. Understanding interest rates and repayment is crucial. Interest rates can be fixed or variable. Repayment options vary, including fixed, graduated, and income-based plans. Responsible borrowing is key to financial stability. Always assess your need, understand the loan terms, borrow only what you can repay, and avoid high-interest loans like payday loans. Key debt repayment methods include the debt avalanche, focusing on high-interest debt first, and the debt snowball, starting with the smallest debt. Balance transfers and debt consolidation can also help manage debt.